And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Tuesday. John Penn joining this morning, talking a little bit about markets, what's going on. Today, we'll also touch on curbing your enthusiasm for 2025. We wrote an article about that. That's on the website right now at realinvestmentadvice.com. So a couple of things. I thought it was interesting this morning. Meta is announcing that they are now ending their fact-checking program. So remember, over the last 8 years or so, we've had these fact-checking programs. It always reminded me of the movie with Gene Hackman and Will Smith, where it was all about the government oversight. And one of the questions that was asked is like, who's checking the checkers, right? And that's always the issue with the fact checking, which is, well, who was checking the fact checkers to make sure the facts were actually correct? Well, that was a huge debacle and lots of problems with it. And so Meta's finally ending that program. And we've seen this happening other places as well. X has also done it. And they're moving towards community notes. So this is where the community will essentially do the fact checking. So I'm not sure it's any better, but it's an interesting change in dynamics. Boeing also today, they are looking back over the last year and talking about this morning on CNBC is like, okay, well, has Boeing been fixed? And the answer is no. So they continue to have problems. That stock has been under tremendous pressure. And, we'll see. The question is whether or not they can fix Boeing at this point. And the answer is yes, obviously, but it's going to take a lot of overhaul to get that done. Outside of that, though, we've got some economic data coming out this week. Thursday, again, markets are all closed on Thursday this week because of Jimmy Carter's passing. And so we will, when a president passes, we have a day of mourning. So that will be on Thursday. So all markets will be closed, which is going to pull forward all that data to Wednesday. So on Wednesday and Friday, we're going to have a lot of economic data coming out. Of course, Friday is the big employment report. That's the one everybody's going to be watching on. Now, one thing about that employment report is this. This report is going to be for December. So we'll look back and we'll see if there's any kind of revisions to, downward revisions to employment, et cetera, for the month of December. One thing we'll be looking for, of course, is retail sales, consumption, those type of things for December because of the Christmas holiday shopping season, see how well that went. In March, we're going to get the revisions to the to the employment data for 2024. We are likely to see another big downward revision in that employment data over the last year, which is going to probably wipe out a lot of the gains in employment that we saw. And remember, the previous one we got in March of last year took away 800,000 jobs. We're likely to see something very similar to that in March of this year. That's because the underlying household survey in employment has been exceptionally weak. The big driver for employment has been government hiring. We've had a massive surge in government hiring over the last really year and a half. And that's where a big chunk of the employment gains have actually come from. So again, we've seen, that's been one aspect of the data that's been supporting the economy and supporting the economic growth, supporting the markets, has been this big surge in government hiring. That's likely going to change under the new administration, particularly with the Department of Government Efficiency, et cetera. We could see a contraction in that government hiring. And if we do see that, we are going to start to see a weaker employment data going forward. And with markets rather exuberant on their outlook, and again, this is part of, and we'll touch on this in a few minutes when we go through our article this morning, but when you start looking at where earnings come from, which is from economic growth, there are some reasons why we need to be a little bit more cautious about our outlook for 2025. And again, we're going to talk about that in a few minutes. But here's what you need to know before the bell this morning. So the good news is yesterday, markets had a really, really strong open yesterday morning. And we got not only back above the 50-day, but actually rallied above the 20-day moving average early in the morning. Now, the markets faded off into the afternoon. And we did come back below that 20-day. So failing that first test of resistance at the 20-day moving average, but we did hold above the 50, and we've started to turn the MACD kind of momentum signal back towards positive. This morning, futures are a little bit mixed. We'll see what happens this morning, but it looks like the markets are going to really kind of struggle in here a little bit. Part of this reason is because rates have been coming up. That's starting to weigh on valuation somewhat. That's putting really kind of a lid on what's happening with the markets here short term. We're not overbought yet, but we are starting to come off that oversold condition. So some of the fuel there for a rally is beginning to be utilized, and that may limit the upside here a bit for the market. So what will be important here for the markets over the next couple of days in particular is going to be getting above this 20-day moving average. Now, if we can do that, that would certainly set the markets up for, didn't want to do that, set the markets up for a rally back towards where we were previously. So we'll see what happens here, but over the next couple of days, this is going to be really critical for the markets to make some kind of advance here. Now, one other thing is that if we take a look at volatility, and this has been kind of one of the big drivers lately, is that volatility has been collapsing back down here. So again, we had this little brief spike in volatility back in December. Most of that's been worked off. Complacency is getting very high again in the markets. The put-call ratio is getting very, very low. So again, there's just a huge amount of complacency in the markets that we won't have a correction. That's also potentially a liability here short term for the markets to move dramatically higher. So again, we may see a bit of a move higher here over the next few days, but having to go from here and kind of make a much larger advance may be somewhat challenging until we kind of get through a bit more of a consolidation period. So again, just be a little bit cautious on your outlook here. Again, and as we talked about before, just kind of manage the risk in your portfolios. We're kind of in one of those periods where the markets could really kind of break down here very easily. The underpinnings of the markets are getting a little bit weak in terms of breadth, relative strength, these type of things. So when you have that kind of weak foundation, that does set the markets up potentially for kind of an unexpected pullback. Now, again, markets are very, very exuberant right now and very bullish, particularly starting out this new year. So the bias is to the upside, but again, there's that risk. So just be careful with the amount of risk that you're taking. Also, oil prices are one thing too. We've actually finally seen that kind of pick up in oil prices. We had talked about a couple of weeks ago. We said we were adding to our energy positions because oil prices had gotten extremely oversold, and that we would likely start to see a reflexive rally in oil prices. And again, we've done that. Now we've had this kind of fairly decent move in oil prices. Oil prices getting back to pretty overbought conditions. So we've reversed a lot of that oversold. We're back to overbought. Again, we're still working kind of in a long-term defined down channel in oil prices. But there's not a big driver here for higher oil prices. So again, we'll probably be looking at here at some point, take a little bit of profits in our recent trades. Companies like Diamondback Drilling, et cetera, have had huge moves, and that's all fine. But again, this was kind of expected, and this really kind of the strength of this move in oil prices also has been kind of corresponding with the drop in the dollar. Now, yesterday in particular, there was a big drop in the dollar early on, but that dollar's been actually declining for about 3 days here. But again, that's not surprising as well because the dollar's had such a huge move here over a period of time that some type of correction in the dollar is going to be likely. In fact, a move back towards probably 104, 105 on the dollar index would not be surprising at all. Again, just a normalistic correction. Again, when the dollar gets too strong in the U.S., it weighs on economic activity in other countries, so other countries kind of start to counterbalance their currencies relative back to the dollar. So expect a decline in the dollar here in the short term, and we'll see kind of how the markets play out against that as well. That's what you need to know before the bell this morning. When we come back, we'll pick up. We'll talk about curbing your enthusiasm for 25 and the reasons why, and one of them I think you'll be surprised about. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So it's Tuesday, which means that we also have John Penn in studio this morning. John,
good morning.
How are you?
Good.
How are y'all? Did you have a nice holiday?
We did.
You stay home or?
We stayed home. We have a lot of family in town.
Yeah.
Shauna has a big family here in Houston, so we all kind of convene at somebody's house.
Mm-hmm.
So we did that. Then my mom and dad don't live but maybe 3.5, 4 hours away, so they drove in and spent a couple days with us. So we stayed kind of close. We stayed here in H-Town.
Well, yeah, so did we. We had, this was my wife's first holiday in her new house.
Oh.
The house we renovated.
With what, 30 Christmas trees?
Yeah, exactly. So she was all excited, but it was so funny. I don't know if this is the same in your house, but I loved having everybody at home. It was great. The kids were all here. Daughters brought boyfriends, etc. So big full house of people. I was so thrilled when they all left.
It's like, great seeing y'all. When are you leaving?
And even my
nice
wife,
having you here.
I know. Even my wife said after they left, she's like, yes, alone again.
Just had a Christmas vacation. Go fall in love with that out there, Clark. I'm going to take that with me when I leave next month.
What? Exactly.
Next month.
But like I said, love having the kids. But now I'm to that phase in life where it's like, happy to see you go. We'll see you next time.
Yeah. So how long are you staying, hon? What?
Exactly.
Oh, okay.
But I was actually talking to my daughter. That she came down. She was over, and she came over on Sunday, and she was spending the night. I go, I said I'm going to put a sign on your bedroom door upstairs that says Mackenzie's B&B, because she shows up, she gets fed free breakfast, right? Free lunch, free dinner, and then somebody magically makes her room before she leaves, right? So,
I mean, why would you leave?
I know, right?
That sounds pretty good to me.
Yeah. So she's got her own bed and breakfast going.
I like that.
Anyway, all right, couple of things to talk about this morning. So I wrote an article on the website. It's called Curb Your Enthusiasm, and really just looking at 2025 in particular, some of the kind of just 3 risks. And it was interesting. I don't know if you're, John, I don't know if you ever watched Larry David's Curb Your Enthusiasm. Ran its final season this past year. So it had a decently long run. But just, it's just kind of Larry David's view of how everything can kind of go wrong. The best laid plans inevitably go hysterically wrong. And if you didn't watch Curb Your Enthusiasm, it's highly recommended. He wrote for Seinfeld and others, so just very funny guy. Anyway, So, the things to be looking at, of course, as we move into 2025 is earnings. And earnings expectations right now are very, very elevated. And in order to have elevated earnings growth, you've got to have elevated economic growth. Here's a scatter chart of economic growth and earnings. And you'll note that earnings growth runs very close to economic growth rates on average. Now, you do have some deviations, and these deviations occur coming out of recessions. And so when you're coming out of a recession or a financial crisis, earnings get very depressed, and all of a sudden you have this kind of big rebound in earnings as things start. So you do have these outliers that occur, but in normality, earnings run very close to economic growth because it's kind of a simple analogy that earnings actually come from economic activity. So you can't, without economic activity, you don't have earnings. So this brings up the issue about valuations. And so if economic growth is going in a direction, up or down, valuations are going to track that growth rate and GDP. So here's a chart of, and again, if you're driving this morning, don't try to look at charts on your phone. I highly discourage that, particularly in Houston traffic. But if you go to our website, realinvestmentadvice.com, all these charts are there for you. But what's important to understand is there's the direction and trend of economic growth is where valuations will grow because of the underlying earnings. And right now, valuations are elevated well above where economic activity is. And this is something that is going to be more problematic as we get further into 2025 and particularly into 2026. Now, since GDP is quarterly data, it's slow to move. So you don't go make a trading decision today. It's like, I'm going to get out of the markets entirely. No, not at all. But it is worth understanding that we've got some issues with the ability for the consumer to continue to support economic activity. And I run this analysis from time to time showing the consumer gap, right? So prior to really 2000, and really in particular 2008, the consumer was able to pretty much fund their living standard out of savings and wages. So they didn't have to go a lot into debt, right? They might have had a little credit card debt. They might have had a mortgage debt, that type of stuff. But in general, they could fund the majority of their lifestyle out of just income and savings. Post 2008, we've had a complete collapse in that ability. In fact, consumers are having to take on more and more credit card debt every year just to fill the gap between their wages and savings and the cost of living. And so this is why debt just continues to kind of ramp up in terms of the consumer household. And consumers are having to take on the most amount of credit card debt every year on average just to maintain their standard of living. So that's the problem with that, obviously, is there's a limit to how much debt you can keep bringing on to just support your standard of living and not really increasing it. Well, that weighs on economic activity, because if I'm just kind of just spending to meet my living standard but not spending more money, that makes it much more difficult for the economy to grow at a rate fast enough to support higher growth rates. Now, so the question becomes the economy's been doing very well. Why? Well, that's because of government spending. And there's a very high correlation between federal expenditures and economic growth. And so when we take a look at the annual rate of change in federal spending, a good example of this was coming out of the COVID pandemic. We had this huge surge in federal spending, right? We were sending checks to households, et cetera, and we had a corresponding surge in economic growth. Well, after that initial push, economic growth declined and it slowed down. And 2022, we had much slower rates of economic growth. And then in 2023, we had this resurgence in economic activity as federal spending started picking up again. So again, as we had, this either increase or decrease in federal spending, there was a directed impact into economic growth rates. Well, we had the Inflation Reduction Act, the CHIPS Act, et cetera. All that federal spending was helping support economic activity. The question becomes now, what's next, right? We don't have any big spending bills on the horizon. A lot of that federal money that's in the system is now kind of running its course. And ultimately, it's going to weigh on the ability for the economy to grow. This brings us to global economic growth. Global economic growth is not growing, right? Right now, we've got growth in the U.S. because of federal spending. But if we take a look at global economic growth, that is all slowing down and slowing down rather markedly. So we've got this uptick in economic growth in the U.S., but everybody else is slowing down. We're going to import that deflation ultimately into the U.S. in terms of economic activity. So this all, again, weighs back into the most critical question for 2025, which is earnings. And as we've discussed in this past weekend's newsletter as well, earnings right now, expectations for the markets are running at $249 a share. The long-term trend of that is $181. That gap in earnings is going to get filled. And the way that's going to get filled is that earnings expectations are going to get ratcheted down. This is problematic with valuations running at 37 times. So if the markets are going to maintain another 20% up year this year, which is kind of the hope from a lot of analysts, you're going to have a big surge in valuations because earnings can't keep up with those valuations. Brent, this next chart, you're going to have to kind of break down into thirds maybe for me. Just do like the top third, second third. He's going to have to work with this for a second because this is a bit of a big chart. This chart is in the report and is quarterly data. This is the market going back to 1900 on a quarterly basis. Technically, the market is extremely deviated. We are pushing 3 standard deviations above the long-term quarterly moving averages. Again, this is very slow to move. When the markets have been this deviated from the long-term moving averages previously, you've had correctional processes at some point. The last time I posted this chart and wrote about this chart was in September of 2021. And there's a link to the article talking about this chart in today's analysis in September 2021, explaining why these deviations would likely lead to a market reversion. Of course, we had that in 2022. I'm not saying that's going to absolutely happen again this time. But what I am saying is that if your expectation this year is for another 20% plus return year, which is going to be a question we talk about with John Penn right after the break, you need to curb your enthusiasm because you have fundamental issues, you've got valuation issues, and you've got technical deviations that are going to make that a much bigger challenge to overcome. I'm not saying that absolutely it cannot happen. Markets can do a lot of things that you don't expect them to do. But from a fundamental basis, from an earnings basis, from an economic basis, from a federal spending basis, from a technical basis, there are certainly some headwinds to consider as we move into to further into 2025. Okay, quick break. We'll come back, pick up John Penn. We're going to talk about his question that he got talking about what will the market return this year. We'll talk about that next. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA portfolio manager Michael Leibowitz, and chief investment strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I think you're really right on that, Lance, and I don't say that often, but
you better be glad we're still broadcasting on radio. When we come to YouTube, I'm going to tell you what I really think about your comments.
The Real Investment Show podcast.
I know I've got this little safety net right now.
Same show, your schedule.
Can't cuss me out.
Exactly. If we ever go to straight YouTube, man, it's going to be bad.
At realinvestmentadvice.com.
This is going to be an R-rated episode of the Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So, John, you had an interesting question I thought worth discussing a little bit because, just this is kind of everybody's question right now. It's like, okay, well, if I open an account with you, how much money I'm going to make this year? And this kind of goes along with an email question I got this morning, and I had to chuckle at this email because he's obviously young because of the way he phrased his question, right? He said, so I'm looking at the markets, and he says, valuations seem really extended, but if we compare, does the market not trade on fundamentals and the underlying valuations anymore? I mean, if we compare now back to the 2010s, is it drastically different?
Oh my gosh.
And,
the good old days.
And I was like, I appreciate your question, but
it's actually a very good question.
It is a good question.
It's a great question.
But, if the 2010s were not normal, because you had $47 trillion of fiscal and monetary intervention, zero interest rates, and just a massive amount of liquidity flows, and not to mention the explosion in ETFs, which have driven this whole passive indexing monster. So the markets haven't traded on valuations and fundamentals really since prior to 2008. And so you've got to go back to ancient times, back to the 1900s to really,
when the dinosaurs roamed the planet. That's right.
To really get this, to where the markets actually did trade on fundamentals and valuations and those type of things. And that's why it's become more challenging to be a fundamental investor. If you take a look at the gaps between growth versus value, et cetera, it's just kind of enormous, and that's all due to stock buybacks. It's due to passive indexing and those type of issues. What changes that? I have no idea, and I don't know if it ever changes at this point.
Yeah, and I think that's the dilemma. I think that a lot of investors are really wrestling with, where they, I think folks want to invest, but then you look at where the markets are, and arguably they are expensive.
Yep.
But they can stay expensive. I mean,
Right.
you can be kind of buying high right now, and markets can continue to grind higher, right? But in the last segment, you went through a lot of reasons why folks should be a little bit more cautious this year. But in no way did you suggest in there to go all to cash,
Right.
right? I mean, it's about balance. You want to have some of your money invested, working, so you can fight inflation and keep your purchasing power and fight taxes and do the things that you want to do. But it's very easy to say, well, so the question that I'm getting a lot of lately is, well, look at 2023, really strong year. Last year was a strong year.
Yeah,
so is 2025, are we going to have a repeat year? Are we going to have another year of 20% plus returns, right? Is that a realistic expectation to have? And I think folks are, all of the financial pundits right now are coming out with their predictions for 2025. And here's what they think the markets are going to do. Here's what they think the economy is going to do. And you can read 10 to 12 different projections, and you're going to get 10 to 12 different answers. And that's why everybody's confused. They don't know what's going to happen. And that's the secret. Nobody knows.
Right. No, it is.
Nobody knows what the market's going to do.
Right. And that's why we don't come out and every year say, well, we think the market's going to go to, 7,000 this year, or whatever, right? We just wrote an article about this. I don't know if you've read it on our website, but we just wrote an article about this a few weeks ago, talking about our predictions for 2025, and it's all based on earnings and valuations. Because at the end of the day, if you're going to have another 20% return year, you're going to have to have another year of valuation expansion, which we had last year, right? And so the market runs in two measures. Either you're in a period of valuation expansion where valuations are increasing, or you're in a period of valuation contraction where valuations are contracting, as in 2022. So you don't have a period where valuations just go sideways, right? So they're either expanding or contracting. You've got to figure out where you are. So if we take a look at earnings, and Brent, can you bring up the chart for me? So two measures to think about for, and this is what we're working with right now. The historical long-term mean of valuations is around 12 times earnings, right? So we're not going to get to that long-term historical mean. Since 2000, that average PE is running between 17 and 18 times earnings. And so when we start looking at reversions to the mean, we're now talking about reversions back to 17, 18, 19, 20 times earnings from where we are currently at 37. So if we so when I wrote this article, earnings were at $251 a share for 2025. Those are now down to $249 already. So we've already cut $2 a share off that. But based on that analysis, we said, okay, let's assume we have a valuation expansion next year and we go to 29 times forward earnings. All right, that's going to move, and based on that, we actually get $251 a share. That gives us a top end of around 7,200 on the S&P. If we have a market contraction, in other words, a valuation contraction, and we go back to 22 times forward earnings, that's going to bring us down to basically about 4,900. So there's your range of outcomes. And, so there's a reasonable expectation, but if you look at just kind of the normality of it, if we're anywhere between 25 and 27 times earnings next year, we're going to have a slight increase in markets if we get to $251 a share. That's the big if. Now, let me show you a different chart. Let's assume that we don't get those optimistic expectations of $251 a share, and we get a more normal expectation for earnings growth, which would be around 9-10% next year. That's going to bring earnings from $208 a share to about $220 a share next year, which would be more realistic. All of a sudden, that changes the game, because now if we're going to trade at 29 times earnings at $220 a share, we're only at about $6,500. In other words, if earnings contract this year, almost every predictive forecast based on valuation multiples yields a negative return except a valuation expansion to 29 times earnings. So there's a real risk. The whole risk this year in terms of the markets is based on what we can get out of earnings. It's all going to come down to earnings growth. And right now, if you take a look at the S&P, the top 7 stocks, the S&P is expected to grow earnings at 1%. The top 7 stocks are expected to grow earnings at 18%. That's what gives you the S&P growth multiple this year. They're hoping for 14% because it's all based on just 7 to 10 stocks growing all the earnings. And that's not really that sustainable. So we'll see what happens, but I think there's a real risk. And again, this kind of goes back to curb your enthusiasm. If you're expecting another 20% return year, I think you're going to be disappointed.
Yeah, so what was one of the estimates? S&P 500 at what, 6,500 maybe?
Yeah.
So it's currently at what, 6,000? So that's
just round off 6,000. That's about 9%.
It's about what, 8-9% return?
Yeah. It's not bad, but that's going to be disappointing after 2 years of 20.
Where's my 20?
Yeah, exactly.
Well, so that's the thing. I think it's a common theme there as you were going through all of those data points are like with the curb your enthusiasm is kind of, what are your expectations? And are they realistic just as an investor in general, right? Because I can't tell you how many times conversations I have with really prospective clients where it's, hey, these are the returns I'm looking for. I want market level returns. I want all the upside, but I don't want any sort of the downside risk.
Yeah, of course.
Or if the portfolio, if I'm down 2%, oh my gosh, my world's coming to an end. It's like, well, and to kind of say it frank, if you can kind of go out there and find that investment unicorn, let me know. Because, it would be great if you can find an investment where you can get all of the upside but have very little downside return. It's just, the investing, it just doesn't work that way. I mean, there are ways that you can get a fixed return.
Right.
There are ways you can get a fixed return. You can lock in 4%, a little bit north of 4% right now on treasuries. You can get a predictive return. You can lock in a return right now. And about 2 years ago, folks were feeling pretty good about that. Mm-hmm. Felt pretty good to T-bill and chill. And I was locking in 5% yields risk-free. But then
the market returned 20%.
Market returned 20% 2 years in a row. So now I'm visiting with a lot of folks who are what I like to say investing. They are looking in the rearview mirror. They have what is called a hindsight mentality where they say, John, I would have been just a lot better investing in an equity-based index for the last 2 years. And my answer is, yeah, you're right. But then my next question is, well, why didn't you do that? And most of the time the answer is, well, because I was afraid of losing money.
Right. I was listening to some guy on YouTube, and he said the market's going to crash any day now, and so I didn't want to do that, so I bought T-bills.
Right.
Yep. I know. That's a huge problem.
So and there's nothing wrong with having T-bills in part of your portfolio. I mean, we have T-bills in part of our portfolio too. But it's what you have to be careful of is letting that kind of that noise or that fear out there, right? Kind of those external forces. I like to say the media, your neighbors, your coworkers, your friends, your family, letting them kind of infiltrate and they kind of change what your investing personality is, right? So like my investing personality is different than Lance's. Lance's is different than mine. Mine is different than Brent. We all have a different investing persona, and you have to kind of find out what that is and kind of stay true to that. And it's very easy to let these external forces kind of seep in and kind of derail you from what your investing persona is. And so that's why we always talk about the importance of finding out what is your hurdle rate? What is that rate of return that you need for your portfolio to earn over time, for all this to work for you and your loved ones and those who are important to you? And that's really what you need to really focus on versus all these other external forces out there that can derail us.
All right, quick break. We'll come back, pick up with some more questions and get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just on the break, I was just scrolling through some of the chat comments. Y'all got to really...
Y'all are really creative this morning. Yeah. That's all I got to say. I'm enjoying this.
One of the comments though that popped up is that when the Fed cuts rates, the Russell 2000 will do well. That's not exactly true. Here's a chart of the Russell 2000 IWM going back to 2000. I don't have all. I'll go back and I'll do a full chart on this for the entire history of the Russell 2000. Just the data on stock charts doesn't go back that far, so I'll have to do a download. But the point is that when the Fed cuts rates, the Russell 2000 does not do well. It does well after the Fed stops cutting rates. So you don't want to be in the Russell 2000 during a Fed rate cutting cycle, particularly if they are doing rate cuts in anticipation of slower economic activity. So again, just declining interest rates in general, whether it's the 10-year Treasury rate or the Fed funds rate on either end of the curve, is not good for small cap companies because they're being impacted by the underlying economic dynamics. Small cap companies are very dependent on economic activity. They can't do stock buybacks. They can't do a lot of the other stuff to support their prices like large cap companies can. So just be very careful with, and I've seen a lot of that narrative out lately. It's like, oh, if the Fed cuts rates, that's great for small caps. Not really the case. It's when the Fed stops cutting rates that it's better for small caps because that means the economy is stabilized and starting to recover.
Yeah, and I mean, I can see why you would think that with investing in small cap stocks because they typically have more leverage. They carry a lot more debt. So, hey, Fed's starting to lower rates. Hey, their debt expense is going to be lower, so that means they're going to be more profitable. Not always necessarily the case, and that kind of ties into another question I've been getting around too. Is hey, is it going to be U.S. large company growth stocks? Is that going to be the place to be again in 2025? Right?
And I'm going to say the answer to that is probably yes, and not for the reason you think.
Okay.
Right. It's not, the fact that they're going to be the grower of earnings, which they probably are.
Yeah.
But again, the phenomenon that we are working with is the problem of passive indexing. If you take a look at ETFs, than the surge in ETFs this past year. We had $1 trillion go into ETFs this year. So just every time you buy a indexed ETF, right, or you buy a single stock NVIDIA 3X long ETF, it's all fueling. All that money is flowing into the largest holdings in those companies, which right now, the top 10 stocks of the S&P index make up 39% of the index. So 39 cents of every dollar goes into 10 stocks that goes in, right? And the other 490 fight over the remaining 66 cents, right? Or, for that. So that's a problem. I shouldn't say, well, it is a problem, but that's a dynamic that's not going to change until people stop investing into ETFs.
Yeah. And and I think that's the other question that I'm getting a lot of too lately is what will be that catalyst, or what will be the spark to cause that change where you don't really have a market of buyers and it turns into a market of sellers for those broad-based ETFs, right?
No, that was the phenomenon in 2022, though, right, John? Yeah. Is that in 2022, when the market peaked, we had all this FOMO in 2020, 2021, right? Because I couldn't go gamble on horses and sports because that was all closed down. Couldn't go to a football game, right? So I had all this cash, and so all these people that normally gamble on other events started gambling in the stock market.
In equities,
right? Right? And so Wall Street was happy to provide SPACs and everything else for people to gamble with. So in 2020, 2021, we had this huge surge in the markets, and we had this FOMO, right? The fear of missing out. Markets going up, can't wait to get in. And so I was writing some articles in late 2021 talking about, hey, when this ends, it's going to end pretty badly, and we're going to see a lot of people get hurt, which we did in 2022. And I go, okay, well, so we'll get FOMO. We'll get people going, I don't want to be in the markets, right? We'll get a good correction. We'll get really washed out. But that didn't really happen because the whole way down, every time the market dipped a little bit, right, I was getting emails, time to get in. Is this time to buy?
Buying opportunity.
I got to get in. I don't want to miss out on, when the market bottoms, I don't want to miss out. I have never seen a market correction like we had in 2022 where people were wanting to buy the dip. Normally, people are like, get me out. That's the market you're looking to buy. You want the market, the one you want to buy is the one that nobody wants. But everybody was buying that market all the way down, and they were just piling into ETFs, et cetera. And that's why, if you take a look back at 2022, go take a look at it. The market was only down 20% by the end of the year. A big chunk of stocks were down 80, 90%, right, in that period. But the big mega caps, Apple, Microsoft, Google, they weren't down that much. They supported the whole market. In fact, I wrote an article called, talking about the bear market hiding below the surface. Because below the surface of those 10 stocks, there was devastation. But because of all the money, everybody was like, I don't want to miss the bottom. I'm buying an S&P index ETF, right? I'm going to buy that. And they just kept throwing money into those those ETFs, and it was just fueling those top 10 stocks.
Yeah.
Yep. And that hasn't changed.
Yeah. So a lot of questions that I'm getting around are just, what will the markets do this year in 2025? Where do we think the places will be to place assets? Still, a lot of questions around Bitcoin. Oh, Bitcoin. And there are a lot of some of the most conservative investors that I work with
wanting to know about Bitcoin.
They want to get into Bitcoin. All right. It's very much from a kind of a behavioral aspect of things. It's very much of a kind of a herd mentality where you're just kind of following kind of the trend or the herd of what everybody else is doing, without doing any sort of, with very little or to no research, right?
Yep.
And again, I'm not trying to downplay Bitcoin or downplaying cryptocurrency. A lot of the folks that we work with, they have a piece of their portfolio in some form of cryptocurrency. They use it and they don't really trade it. It's just there as part of their overall portfolio approach. But if it does well, great. But if it doesn't, it won't derail them. That's the big key. It's all about balance, right? But it's interesting that how it's just so. What I really love about the profession that I'm in is the kind of the investor psychology of things and how sentiment changes and just our thought process when it comes to where we are investing our hard-earned dollars. And it's just very interesting to me that couple of years ago, some of the most conservative investors I work with, I will never invest in Bitcoin. I don't understand it. I'm not going to put my money in it. And now it's like, well, hey, you know what? I think now they've seen how it's done. And then the question in their mind is, well, it's got to keep going up, right? I mean, Bitcoin, look at it. Look what it did last year. It's got to keep going higher. So I'm going to put some money in it. Well, but then the narrative is, well, of course, Bitcoin's going to replace the U.S. dollar. And I go, hold on a second. Let's have a conversation around this, right? So I don't know. It's just the investor psychology and just the emotion around this, which I find extremely fascinating, where all of a sudden some of the most conservative investors that I work with, now they're wanting to kind of stray away from that investing persona that I was talking about earlier, right?
Yep. And again, it's just, this is part of the market.
Right.
There was the last time that my Twitter feed was filled up with laser eyes, where like everybody was always, Bitcoin's going to the moon, was when Bitcoin was running to 60,000. And, in 2022, it got back towards 30,000, 20,000, 30,000, and all those laser eyes disappeared.
Yeah.
And right. So now they're all back again. So you always have to remember that big speculative moves in markets always get reversed. And that's just one of the very basic dynamics of markets. And look, Bitcoin may very well go to 1 million someday, but along the way, it's going to have a ton of 50% corrections that wipe out most investors, because just like now, everybody's trying to, I got to get into Bitcoin, so I'm going to buy it at 100,000. And at 60,000, 50,000, 40,000, they won't be buying it, they'll be selling it. But that's just human psychology in the way that we navigate this, right? It is.
And for most of the show this morning, you've been talking about, okay, let's look at 2025, and it's going to come down to earnings, some level of fundamentals.
Sure.
It's going to come down to earnings, and it's going to come down to consumers out there spending and supporting the economy. With Bitcoin, what is the underlying fundamental?
Right.
Is there one?
Right.
It's just if Brent's buying it, I'm going to buy it, and if Lance is buying it, I'm going to buy it. But I got to sell mine before Lance does, before Brent does. I just got to hit the exit before you guys do. So
exactly.
Look at the time. I'm out. Right.
Well, no, but that's kind of the whole question, right? And and this is one of the big things this year. Look, and let me be really clear. We've talked about curbing your enthusiasm this morning on the show for 2025. Look, when you have 20% return years like we've had in a row, there's a lot of momentum and sentiment in the markets that can drive the markets. And again, I'm not expecting the markets to crash this year. I'm not saying that at all. And I'm just saying that if you get an 8, 9, 10% rate of return this year, based on where earnings are likely going to be, I think you should be happy about that.
Yeah.
I think if you're going into this market expecting another 20% return year, you're probably going to be disappointed to some degree. And that doesn't mean the market crashed. I just don't think you're going to get 20%. Maybe I'm wrong. It could certainly happen. It's happened before, previously. But there's a lot of headwinds that are starting to really take shape that suggests trying to crank out another 20% advance in the market this year is going to be a bit more challenging.
So we have, well, I don't know if we have time to talk about this now, or maybe you can hit it a little bit later.
Sure.
This week, and getting a lot of questions around elevated yields on the long end of the yield curve,
which is also a problem for markets.
Right. So, which is stressful for the markets, and has our thesis around owning longer duration bonds changed? Getting a lot of questions around that too.
Yeah, no, it hasn't. In fact, probably buying more sooner than later. So anyway, all right, wraps up the show for the day. Be back tomorrow. We will pick up on what happened with markets today. Be sure and get by the website. Get registered for the summit coming up on January the 18th. It's not this Saturday. It's next Saturday. Live event here in Houston. Love to have you here. We've only got about 25, 30 seats left, so they are filling up pretty quick. So get by the website, realinvestmentadvice.com. Get your tickets today.